Hey, we want to welcome everybody to the latest episode of the Denny Artache Show. Happy New Year, January
Happy New Year.
2022. I mean, it happened fast, right?
I think right around the corner.
Yes, that's what we said like last week. Anyway, Happy New Year to all. And as you know, the Denny Artache Show, I love to have different guests. You all know about the Artache Financial Group, my company. But, you know, we talk about entertainment and different issues. Today, I have a very special guest and actually a partner, Mr. Rick Martins with Inland Capital. And we're going to talk about a subject that I've been seeing get a lot of attention for the last year or two, and that is for 1031 exchanges. Folks, you or someone you know probably has real estate property, investment property, a rental property, a commercial storefront somewhere that you would love to sell in this hot market, but you won't because of the taxation. So Rick is going to talk about how 1031 exchanges work, how clients can defer the taxes. And last I checked, people would love to pay as little taxes as they can. So Rick is going to talk about what is a 1031, how to utilize it, but also importantly, his company is the largest player in this space. I mean, Inland Capital has about 30% of the market share of a huge market. So, Rick, always a pleasure getting with you, brother. How you feeling today?
Feeling very well. Thank you so much for inviting me.
All right. So first of all, what can you want to talk about Inland first? Because that's a heck of a company that you work with and you're part of.
Well, Inland, very proud to speak about Inland. It has a very storied history. It was actually started by 4 school teachers in the Chicago area, and they started supplementing their income as public school teachers with real estate investments.
Okay.
And their company just grew and grew, and lo and behold, 52 years later, here we are, and the 4 partners are still partners today.
Imagine that, teachers needing more income.
Right.
Well, I've been helping teachers for a long time, and I've seen their struggles. So Inland, like I say, how did they get to be so big? They have about 30% of the market share. That's not a small task to do.
Well, it's we got big by starting off small and going up to and learning through the different economic cycles. At one time, Inland was the largest landlord for Walmart stores in the country.
Okay,
and we have launched several real estate investment trusts that are now publicly traded, but we've always been in the private equity space. And 1031 exchanges, as we discussed, has always been a tool in the real estate world to continue to create and expand your wealth in real estate without paying the capital gains taxes immediately, right? It's a tax deferral strategy. And so it's been utilized in our regular course of business. And then obviously we see the interest, and we saw the interest several, way back even in the 90s, because 1031 exchanges are a 100-year-old. It's a 100-year-old code, tax code.
Yes, I saw that it came out in 1921, so now it's 101 years old, and. So talk about how it works in conjunction with the Delaware Trust, because that's what makes it unique, isn't it?
Well, let's just, what is a 1031 exchange?
Yeah.
What are you talking about? If folks have investment real estate,
yes,
and in today's market, they have highly appreciated investment real estate. There's a lot of folks that have managed their own real estate for a long time. And it's time for them to retire, or they just don't want to manage their real estate anymore personally. They don't want to be responsible for the tenants' taxes and trash. And it's time to sell. And what would normally happen is that they bought a property 25 years ago for $150,000, and now they're selling it for $1 million. And they have $850,000 in profit. And they're going to be subject to 20 to 25% capital gains tax. So that's $170,000, $200,000 that's going to be paid to the taxman. Now, how can you defer those taxes for as long as you'd like? So 1031 exchange is a tax deferral strategy for selling investment real estate. And what the tax code 1031, section 1031 of the tax code says is that you can effectively swap your property for another property of the same or equal value, right? Or equal or greater value. And that's how a 1031 exchange works. Now, folks that are retiring or folks that no longer want to manage their own real estate, they're in a real pickle, right? Because they either have to pay their capital gains tax or they have to go out, buy another property and be liable for that property and manage that property and also be restricted to the size of the money that they have to buy the properties. They can't go out and buy institutional properties. They can't go out and buy portfolios of properties. And that's where Inland comes in. So Inland allows you to sell your investment properties and then be able to swap it and do 100% tax deferral and swap it for some institutional real estate, which we'll talk about in a second. Mm-hmm. Let's talk a little bit just about the rules of the road. On a 1031 exchange, Section 1031 states that if you want to defer your taxes, before you think about selling your property or closing on your property, you have to ensure that you have a qualified intermediary that accepts the cash or the proceeds from the sale. Without a qualified intermediary, you have busted your 1031 exchange. So it's very important.
And this is important, folks, because it's not like you sell your property and then you say, oh, I forgot to get the qualified intermediary. Do I have 30 days to grandfather that in? You cannot accept the monies to do the 1031 exchange. And look, let's face it, it's true. Many people, they get to a certain age, the last thing they want to do is manage a property, deal with tenants, and all the upkeep of it's also true for people who have inherited businesses from their parents. Maybe it was a gas station or a certain property that now that they're of retirement age, it could be worth 10, 15, $20 million.
That's correct.
And their original cost basis was pennies on the dollar. Mm-hmm. So this is just a great way. And listen, when you say defer, look, you can defer it until you die and then pass it to the next generation. Isn't that true?
It's kind of funny, Danny, because most people refer to 1031 exchanges as a swap till you drop investment, right? So you can defer your capital gains 100% of your capital gains throughout your lifetime if you continue to do 1031 exchanges as properties are bought and sold, right?
Yes.
And then once you pass on, then your heirs will inherit the property, your last property that you owned, or DST or investment property that you owned, and the cost basis is stepped up, as they call it, a stepped up cost basis. So as an example, if you started with $1 million and you kept buying and selling properties, and now you have a $10 million portfolio, and if you were to sell that $10 million portfolio the day before you passed away, right, you're subject to $9 million of capital gains taxes, and so to pay the capital gains taxes on $9 million. If you passed away and your heirs received that property is now, the cost basis on that property is $10 million, and if you were to sell it the next day for the $10 million that it's worth, there is zero capital gains taxes owed on that.
Which is such a great vehicle. I love with my company and to partner up with CPAs and tax professionals who get this, but I think more people need to understand that this exists. Let's face it, the real estate is hot right now, and there are a lot of people who would love to take advantage of the gains, but paying Uncle Sam just holds them back. Now, it's an interesting thing. You can defer taxes, but because of companies like Inland, you can get a basket of different inventories and portfolios that you can also get income from. And that's one thing that's very unique about it. Now, folks also know that besides getting the qualified intermediary, you have to identify a property in 45 days.
That's the part of it. There's a little bit of time pressure there,
Yes.
Denny, and that's the fact is that you from the day of the close, you have 45 calendar days
To
identify up to 3 properties that you wish to purchase with the proceeds from the sale of your property, where the funds are now sitting at a qualified intermediary. A qualified intermediary is basically like an escrow agent. They're an uninterested third party that just holds your funds. Okay, and so now you have 45 days. Those are calendar days. Weekends are included. Any holidays are included. So 45 days happens quickly. And then once you've identified your properties, then you have 180 days to close, right? And that time, sometimes if you're buying your own properties and if you're a commercial investor, you know how sticky those closing dates can get when all of a sudden you need to have a new study, a new environmental study, or there's a new titling issue and so forth. And if you pass those 180 days, you're busted your 1031 exchange.
And that's really important, folks, because think about it. You could find a property because you have to have the same value or higher. Maybe you sell something that's worth $2 million, and you find a property that's only worth $1.5 million. Well, through the partnership with myself and Inland Capital and Rick, we can place that $500,000, because if you don't place it, you lose the ability to defer it. And this is very important. There are a lot of realtors that are understanding this now, because it is tricky a lot of times to find. Now, the term is you have to find like types of properties, right? But it's, there are a couple of good examples. Now, if you have a rental property, you can invest into a storage property, right?
Yeah,
storage or rentals.
Everybody thinks that like-kind property means
exactly
that
like
if I have a vacant lot and sell a vacant lot, I have to go buy another vacant lot.
Right.
No, like-kind real estate means that you have to buy investment real estate. So
not your primary residence.
Right, not your primary residence. It can be your vacation home that you rent, right? Not that you just vacation in, but that you rent for a certain amount of time during the year, or all the way to a commercial office building, whichever comes in between. But you can switch between the categories. So if you have self-storage rentals, you could buy a multifamily apartment complex. If you have an industrial space, you can buy a piece of vacant land, as long as it's for investment purposes.
And again, if having a basket of portfolios and institutionally managed properties that are available. There are too many realtors that have told me and personal people that have lost sales because they could not close that deal. Like you say, now they've got to get it inspected and they've got to go jump through the hoops. We have literally helped people, folks. Rick has, we have, that literally had a couple of days to find a property, or they lost the distribution and the deal was busted. So
that's interesting that you mentioned that, Denny, because that's what the Delaware Statutory Trust is all about. And that's what allows us to be able to find these properties so quickly. Again, as a reminder, we're a institutional asset manager. We're not a real estate company, and we're not talking about looking for properties as a real estate company does. We actually, at Inland, we buy the properties ahead of time, and then we partial out the equity to investors.
A lot of times you buy these for cash too, don't you?
We buy them for cash, and then we'll place leverage on them as appropriate and as needed, because many investors have leverage on their properties, and the rules state that the proceeds of the sale have to be equal to or greater than the new property, right? So let's say if you have $1 million sale of your property and you have $500,000 in debt, you have to have $500,000 in debt in the new property. So you need to have properties that have debt on them. So we have them everything from zero debt, all cash, and all the way to 82% debt. So we are able to help all spectrum of investors that are in need for properties. And again, on the Delaware Statutory Trust, why do we use or utilize the Delaware Statutory Trust?
Has that been around as long as the 1031s, or is the trust The statute, they were called something else, right? Weren't they from England?
Were called Royal Statutory Trust. They've been around since the 1600s.
Since the 1600s,
so
okay.
Delaware Statutory Trust is just it's an ownership structure that allows for individual investors to have fractional ownerships of large institutional type properties, right?
Okay.
So it opens up the entire field. So in order to understand Delaware Statutory Trust, it's very, very simple. The building is owned by the trust.
Okay.
The investors are the direct beneficiaries of the trust by the percentage that they own the building. Does that make sense? If you are a 1/10
Sure. And they don't have to
owner,
deal with the management or any of the other stuff that drives people crazy. Folks,
right.
I want to tell you that you can call Artache Financial Group at 561-537-5897. The number again, 561-537-5897. And just so you know, you may not live in Florida like where we're headquartered. We help people all over the country. And a lot of these properties are all over the country. It's not just, there's sometimes there's a lot of inventory and sometimes there's a shortage because these deals go by so fast. I mean, there's different ways that can be structured, including some of the yields can be utilized on a tax-free income basis, correct? I mean,
that's correct.
Talk about how that's structured, because right now municipals are not. You can't get a 3.5-4% tax-free yield in bonds now comfortably. So how do 1031s do that as well? Do they structure those type of income for investors out there?
Well, as you know, 1031 exchange is the strategy to defer taxes.
Yes.
The Delaware Statutory Trust programs are investment vehicles that are utilized for 1031 exchanges or for investors that are interested in being passive investors in a very good property, as you and I had discussed earlier today with some folks that really like the properties that we're talking about, right? Now, one of the advantages of doing a 1031 exchange is that if you've utilized all your depreciation throughout the years for your original property,
yes,
and all your amortization, and you've written off all that, you will have to pay the capital gains all the way down. That's what reduces your cost basis. So when you do a 1031 exchange, you start the process of amortizing and depreciating the property all over again. So in many occasions, a DST will be 100% tax-deferred income. So as you are a fractional owner of a portfolio of properties or one property,
yes,
whatever happens to be in a DST, in a Delaware Statutory Trust, you get 100% of the net operating income of the properties in that trust, and you get 100% of the profits, right? And so, but you also get 100% of the tax of the tax deferment. So it's a pass-through investment. And in many occasions, there'll be, for the first 5 years, 100% tax-deferred income. This is not K-1 income. This is 1099 income. It's called a substitute 1098. So you see it in box number 1 where it says taxable income. It'll be 0, and it says non-taxable distributions will have all your distributions in them. So it can be very advantageous for tax-free. It's not tax-free income, it's tax-deferred income.
Tax-deferred income, yes. Well, how would you say that, what is the most ways that people utilize the 1031? Is it mostly to pass it on to the beneficiaries, or are they taking advantage of, hey, maybe I can get myself a decent yield and not pay taxes on that? How do they utilize a 1031, most people?
Well, the 1031 is utilized 100% for tax deferral purposes, okay?
Right.
Now, you don't have to defer 100% of the taxes. You can defer 50% of the taxes. If you want to pay capital gains tax and cash out on some of your gains, you can certainly do that.
You have that option.
You pay the capital gains on the part that you keep, right?
Okay.
And then whatever you exchange, that becomes tax deferred. Now, what I believe you were stating is, who wants to use these products just as a hey, I really like that investment and I'd like to invest in it because I can't find income like that, right?
Right.
And I want to have a non-diversified portfolio, and I want to have something that's not correlated with the stock market or with any of my other real estate investments, or I'd really rather have a institutional management team manage my real estate portfolio. You can enter into a Delaware statutory trust as an investor. The minimums are typically $100,000 on any programs that are out there, and you can just invest your money directly into and then you will be a fractional owner of that DST, right? Which owns one property or multiple properties. So it doesn't always have to be a 1031 exchange. Now, in the real world, 90% of all investments in DSTs are for 1031 exchange purposes. About 10% are just cash investors that just like the deals.
Well, it's interesting that you say. I think the other thing that people like about this is, yes, they're non-correlated to the equities market because, the S&P got 28% last year. Real estate also gained like 38%. I don't think these are sustainable numbers. However, when you have an institutionally managed portfolio, like maybe an Amazon shopping center or a high-end rental community, not only are investors realizing capital appreciation, but they're some of these have a 10-year guarantee that they're collecting rent. And I think a lot of investors are looking for things they can count on and know that it's going to be there. But that being the case, would you say that the average hold is maybe between 4 and 5 years? If Inland feels like it's time to sell it and they buy the next property for the investors, what is the average time the 1031 properties are being held?
Well, I could tell you historically,
Yeah.
right? And history never tells you what happens in the future.
No, it doesn't.
So we don't know, we don't know what's going to happen 5 years from now. I don't even know what I'm going to have for breakfast tomorrow. But we can't make those kind of predictions, but we can look at past history and see patterns, right? And different sectors. And we're invested in multifamily sector, which is apartment complexes, in industrial real estate, which is like an Amazon distribution center, medical office buildings, senior housing, student housing, and each sector has its own mechanics to when you would sell, right? And so I'll just say that typically when a window of opportunity opens to sell, we will jump through the window. Now, everything that we project, and when we do our projections, our financial projections, it's all done on a 10-year basis.
Okay.
But in reality, real life and projections intersect, and typically, 4 to 6 years is a typical hold period. Obviously, if we're managing a large portfolio and we go into a recession where there's a 3 years of recession, you want us to professionally manage that portfolio in order for you not to lose your investment, right? And so maybe it might be 7 or 8 years or longer,
right,
to when the economic cycle changes, right? But in typical form, 4 to 6 years is a target, but we look at everything from a 6 to 10 year cycle. But if you look at what's actually been done, it's 4 to 6 years is a very good measurement.
Well, listen, besides rental unit properties, commercial, an interesting sector that has been doing very well is storage units, right?
Right.
I mean, that has been doing very well. Does Inland plan to, I'm not asking you to make any predictions, but hasn't that been a hot sector in the last couple of years?
Well, I'm not an asset manager, so
No?
I am not an expert in the ins and outs of self storage. I know enough to be dangerous, but we are in the self storage market. We have about almost 10% share of our entire portfolio that we manage is self storage, and we manage about $10 billion. So we're looking at $1 billion worth of self-storage that we manage. If we have $1 billion worth of storage as 1031 exchange DST programs, we probably like the sector pretty much. We are still very active in self-storage, and yes, we do think it has very good financial directives, and we like the market a lot.
Well, look, you have you're number one in market share. Like I said, I think you all have about 30% of this huge market. That's just amazing. Now, in our conversations, you also stated of something that comes up called boot, how to eliminate boot. So how does that come into play with investors and 1031s and DSTs that happen? What is boot? What is boot?
A boot is the remaining profit on the sale.
Okay,
of your relinquished property. And it also, what it boot is the leftover debt that you might have on the property that you cannot match to your new property. Again, the rules state that the equity has to be equal to or greater than the equity of your property that you sold, and the debt has to be equal to or greater than the property you sold. Okay. Now, if you don't have any debt on your property, you don't have a problem with the debt boot, but any profits are called boot, and
but
boot is
specifically,
taxable.
Exactly. That's my whole point. If you don't, like I said earlier in our conversation, maybe there's a realtor or an individual that sells a $2 million property, but they're short $500,000. So if they don't fill that $500,000, then they'll just pay the gains on the $500,000.
That is the boot. So what it is, it's your realtor has sold your property for $2 million. You want it to do 100% tax deferral.
Right.
So you needed to find a property with $2 million, right? The realtor only was able to find you a $1.5 million property. You really like that property, so you go ahead and buy it. That $500,000 remaining must be invested into another property, or it becomes boot. And boot is taxable at 25%. So again, I'm not a CPA. You have to go to your CPA to find all that. But that is how you eliminate boot, is you can use any of our portfolios. And since we have a $100,000 minimum investment, you can actually fit the stuff that's left over. We call it the leftovers.
Exactly, right. And that is true. That's a great thing to have low minimum investments. $100,000 to invest in a institutionally managed portfolio. The other thing that is interesting about this is it limits personal liability as well, right? I mean, which is important. I think you were telling me that sometimes you could get into a property where if it defaults, like I don't want to mention names, but there are some drugstores that they're closing a lot of locations. So if you're the owner of that individual location and you still owe half of it in the property, you could be liable for it. Where I think the DSTs eliminate that, don't they?
Right. We, as Inland is the sponsor, we provide the leverage or the debt for that property through our bank lines and through our mortgage relationships, our commercial mortgage relationships, obviously. And the loans are non-recourse to the investor. And what that means is the investor is not responsible for those loans. So we are responsible for those loans. And it just removes one area of responsibility and liability from the investor. Also, typically in DSTs, there are no such things as cash calls. What is a cash call? If you buy a property, either by yourself or with partners, and all of a sudden the insurance triples, right? You're going to get your partners to come to you or the asset manager to say, "I'm sorry, folks, but I need you to cut us another $20,000 check."
Yeah, that's always great.
We have to cover these unexpected expenses, right? And that this is greatly reduced or completely eliminated through the use of DSTs. And more importantly, there's no more management responsibilities, right?
Well, that's the thing. Like I said earlier,
really important.
You're of retirement age. The last thing you want to do is manage a property, collect the rents, and go through it. And think about it. investors have a chance to have such great diversification. Maybe you put some of it in a multifamily apartment complex. Maybe you put it in a healthcare building. Maybe you buy a self-storage facility. Maybe you go into an industrial warehouse or student housing. And that's the beauty of having a plethora of inventory to invest in. That's the part that I like as well, because, again, you're not managing. Inland is. and Inland is, you all have the specialists that decide not only on which sector, but they design and engineer what they're investing in. They have a vision. And if they think it's time to sell, that they're going to make the profit, they make that decision. The investors do not, correct?
That's correct. And we invest in 12 different property sectors. Always remember that the DST itself is always one sector. So each DST is a different animal, right? So if I do a multifamily, which is apartment complexes, a Delaware Statutory Trust that has a multifamily property or properties in it, I can do multiple properties in a Delaware Statutory Trust. They will all be apartments. I won't mix self-storage and apartments and medical office buildings. I will have Delaware Statutory Trust, I'll have each individual program will be their own sectors. But I typically have 3 to 4 programs available at any time, unless we're at the end of the year, like we just finished the end of the year.
Yes, last month.
And we now have to build up our inventory of programs again. As you know, we only have a couple programs available today, but we'll build that up into more sectors. And so you are able to actually diversify your own little real estate world from your condo that you had on the beach. You can actually diversify into 4 different, massive portfolios of institutional properties. And, having no correlation to the stock market, being diversified by geography, by market, and by sector, it always reduces risk, and increases returns in the long run.
Well, again, the diversification is what all investors should be interested in, that, not putting all your eggs in one basket, because as I'm looking at some of these annualized returns, if you lump them all together, it looks like the weighted average return, which again, folks, there's no guarantee that it's the future, has been 6.79%. And there's certain sectors that are higher. Everything in life and economics certainly has a cyclical. What was hot last year may not be hot this year, and what was dragging a couple of years ago could be all of a sudden hot. So it seems to make sense to me to diversify in different sectors, and that's where your expertise comes in. If a client is looking for a custom portfolio, and the thing is, as you get into the higher end of investors, now you can get into some private offerings as well. Is that not also what Inland does? Or
we try to accommodate all types of investors.
Absolutely.
And we do have corporate investors and institutional investors that have very large holdings. And we also have individual investors that are of very high net worth. That like to know that they're the only investor in the program, right?
Right.
They want their own investment, and yes, we on occasion, if everything matches up correctly, we will do that. We will try to accommodate a custom deal, and it's again, there are a lot of factors that come into that, or that come into play for a custom deal. And it's typically over $25 billion, so it's not something that we do on a daily basis.
I see. Well, folks, if you'd like to know more, again, the office line for our Artache Financial Group is 561-537-5897. It's 561-537-5897. And what we're talking about are 1031 exchanges. So it's primarily for those who currently own investment property, real estate. It could be a rental home. It could be a commercial building that you have. And you either want to get out of the management business, you'd love to get the profits, but defer the taxes. You'd love to get out of the responsibilities of managing and taking care of properties. And most of partnerships that I've formed with tax professionals, they get it, they understand it. But I have to tell you, if you're a realtor out there, I know that you would like to get both sales, but I think you're leaving money on the table because many of your clients won't give you the listing of the first sale unless you've satisfied their need to defer the taxes with the second sale. And as we stated earlier, it's often difficult to get that second property. So we literally could fix that for you in a matter of days. And think about that. So we don't have to deal with the inspections and the normal headaches you would go with an individual piece of property as opposed to an institutionally managed property. And there's liquidity in this, is there not? I mean, it's not like you have to tie up your money until you drop, as the saying goes.
Well,
right?
the liquidity is on the is in the discretion of the asset manager.
Okay.
These are not liquid products on a daily basis.
Yeah, I don't mean that you change your mind a year from now and you want all of your money. That's not what I mean.
Passive investor.
Yes.
The liquidity is when we find an opportunity and there's a window of opportunity that opens to sell the property at a good profit, we are certainly going to do that. And our track record illustrates that we have done that with great frequency. We've had 238 programs, and 125 of them have gone full cycle already. And 70% of
And when you say full cycle, they've sold the property.
Right.
So let's talk about that, because I think that's important for people to understand, and I want to understand as well. When you invest in a DST and a 1031, and you've invested in this property, if you wanted to cash out, you would have to wait until they sold the property, or could you just say, give me my share of proceeds? How does that work?
When a DST is sold,
yes.
Right? When the property or the portfolio properties is sold to another party, excuse me, to another party, then you are given the choice to do either another 1031 exchange on your own or with us, or take your money. It's totally up to you. It's your money.
But that's the only time that an investor could say, I've changed my mind. I've lost my mind, and I'd love to pay all these taxes now. So
Yes.
Cash it out for me.
Correct.
So that's the only time that they could get out. There's no partial liquidity. There's no, hey, give me 10% or whatever the deal is.
No.
And then you have a choice to either go to the next investment or to cash out and pay the taxes.
Well, it's very telling when 70% of your investors reinvest into another 1031 exchange. It's pretty clear that that folks are utilizing this for tax deferral purposes.
That's the thing. I've met some people that told me they had the advice from some, for lack of other words, professionals that said just pay the taxes and get it over with. But I think most people would like to pay as little amount of taxes. But the other question is this: if they're in a DST and a 1031, and they're in a property that can pay them income, that income itself is taxed as ordinary income, correct? It's not capital gains.
No, it's taxed as ordinary income, but again, like we talked about before, you have a brand new purchase of a large institutional portfolio or property that has depreciation and amortization expenses, right, that we call expenses or deductions against the income. So on many occasions, on an average, about 70 or 80% of the income is tax deferred as well, right?
I see.
So you're putting the cash, remember, it's not what you make, it's what you put in your pocket. So if we have 100% tax deferral on the income of a logistics, industrial property.
What would determine that you have 100% of the income?
It is determined by the leverage or no leverage, the newness of the building, how the purchase was done. There's many factors that determine that. But on average, 80% of the income from virtually all of our programs are tax deferred income.
Maybe that's where the clients can have some liquidity. In other words, if they were to invest in this and say, I would like income from this.
Oh, no, there is no choice. You are getting income every single one of our programs offers income.
Okay.
And it's because, again, I said this before, you own the property as an investor. The investor owns the property. We are collecting the rent on behalf of the investor, and we're distributing the 100% of the rent to the investors after expenses. So the 100% of the net operating income after expenses goes to the clients, goes to the investors.
But the difference is if they're not collecting that income, it's just reinvested. And
in a DST, you cannot reinvest income.
Okay.
And you cannot, and there's also it's a good point you brought up, Denny, because the subtleties are, the details are in the technical area.
Absolutely.
Right?
People want to know.
The devil's in the details.
That's right.
And in a DST, these are not speculative investments, all right?
Okay.
Because I can't buy an apartment complex and say, oh, I'm going to now build a parking garage, right? So I am going to withhold your income because I decided that a parking garage would be very beneficial for this apartment complex. I'm not allowed to do that. You cannot substantially improve the property, it's called. Substantially. That doesn't mean that you don't paint the property and keep it maintained and keep it in ship shape, or have to put a new roof on it, whatever you have to do to maintain the property. You can't. So basically, these are all DSTs are non-speculative real estate. These are stabilized properties, stabilized rental properties, meaning they're fully occupied already. They already are an ongoing business.
Well, the reason I ask is there may be some investors out there listening to say, hey, Denny and Rick, are you telling me that I could get mailbox money each month sent to me with this investment? I mean, because that would interest them. I mean, look, they don't have to manage anything. It's growing, but oh, by the way, you're going to send me a check each month? I think that some of them may have that as a question. Can it be structured that way?
It is a fact.
It is a fact. You don't have a choice.
You will get the income. It's not reinvested in the firm. The income has to be passed through to the investor.
It does. Okay.
Now, there are structures where, if you're highly leveraged, like we have properties that are highly leveraged.
Right.
And they're not speculative. They're just highly leveraged for a technical reason.
Well, look, I think we're talking taxation here. So I think most listeners are saying, well, Rick, Denny, am I going to pay taxes on that income you're sending me? That's what, and it depends on how it's structured, you said.
Right. It depends.
So investors
typically, you're not going to pay about 70 to 100% of that income is going to be not taxable on the year that you receive it.
Okay.
Okay. It'll be taxable at the end when you sell your property.
Ah, I see.
Okay. Because it goes against any deduction against your income tax, your yearly income tax, right? The ordinary income that you're receiving, you have to pay income tax on that. If it's tax deferred income, you don't pay income tax on that, but when you sell the property, then you have to pay income tax in the form of long-term capital gains, right? So not only is it a tax saver because ordinary income is more than long-term capital gains, but you also have the ability to do another 1031 exchange and defer that income tax even further, right? So because the deferral of your income, the taxes that you don't pay on an annual basis will be deducted from your cost basis or what you paid for that property. So that makes your profit even larger than what it would be when you sold the property, right? But that's at a capital gains rate. That's why it's very beneficial to swap till you drop.
Yes, absolutely. And that's what I wanted to, so that clients can understand that. Would you say, I know you're not an analyst, but some of the, a lot of these will pay a 3 or 4% dividend, so to speak, or to the investors that invest in this, right? Is that a fair assumption, or is that overly aggressive?
Well, in different economic periods, there's different economic incentives or rewards for owning real estate. Back just 5 years ago, most programs, DST programs that were being offered, were offering between 5 and 7% income. Now, when I say being offered, again, 100% of the net operating income of a property has to be passed through to the investor. So that's just was the model, right? We had very low interest rates. We had very low inflation. So
Absolutely.
our assets were going up in value, and the expenses were running below projections. So you were able to pay the 5 to 7% income.
That's why I think it's probably more like 3 to 4 these days.
It is now in today's world.
Yeah.
With with inflation creeping up and with interest rates creeping up, et cetera, it has now become a world, and real estate being more expensive versus the rents that you're collecting, right? The rents have to catch up. That you're getting about a 3 to 4% in our programs, right? Because there could be other programs that are much more speculative, and again risk and reward, right? So I know of programs that pay 6%, but they're
riskier investors.
They most likely are much riskier investments.
Well, look, it's. I think 1031s are great tools to have. I don't know why more people do not take advantage of them. They certainly should. If you have a good tax professional or a planner like myself or a company that we focus on that. Because, folks, let's face it, in my opinion, taxes are not going lower. They're going higher as we look forward. Inflation is a relative factor. We still have, I love that we've done so well last year economically, but going forward, it's these non-correlated type of investments and the fact that you can defer the taxes that more people should find out about these. And it's so interesting. This has been around for a long time, but yet it's not it's not a talk at, when people are getting coffee or by the water cooler. And more people should know that these are available to them. You have to be a licensed financial person like myself to offer it to clients. So it's, you can't just buy these direct like you can with certain things like insurance products. The person has to be licensed. I have 5 licenses. And folks, whoever you go with, because Inland is the largest in this space. There are certainly other good companies because not everyone has inventory at once, and you just never know when a client or yourself needs to fill this void within a week or two or a few days. But make sure it's a reputable company. Make sure it's someone that has a reputation of doing well by the clients, that has professionals out there buying these properties. But 1031 exchanges, they're not going away. There are certain other things you're looking about changing. Perhaps the opportunity zones. Perhaps they're going to change the standard deduction. They're talking about lowering the threshold for estate taxes. They're talking about doing a lot of things. Now, Rick and I are not a conspiracy theorist. We deal with what we know and what's happening today. And when they change the laws and things, we will adapt. But for now, it certainly looks like 1031s are not going away. It's been around a long time. It's a great tool to have. Many people have real estate holdings that are not their primary residence.
Right.
Just appreciation in real estate alone has done very well for people. Think about, I know it's hot now, but even if you just invested 10 years ago, you've done well. 5 years ago, I know we had the big thing in 2008 because of the bad loans that were out there. But this is, I don't think we'll ever see that again because they stopped the criminal behavior that was going on and ruined it. But these 1031s and these DSTs that people can take advantage of having an institutionally managed portfolio, properties that they pretty much have guaranteed their rent payments for the next 10, 15 years. We're talking household names. There are many names, and, there's probably a lot of things that you can talk about inland, but today I wanted to have Rick talk about 1031 exchanges, what they are, how they're utilized. And the fact that, yes, it's not just for rich people. The minimum buy-in is $100,000, which most people who invest in the stock market and do other things is something that they can handle. But first and foremost, it is solving a taxation issue for properties that you currently own.
Right, and just to clarify one point, guarantee is a strong word.
It is a strong word, and I try and stay away from it.
Right, and that is referring to what's called triple net leases, where we do offer programs that have triple net leases. That the leases are guaranteed by AAA or AA investment grade companies, and that's what when we call it mailbox money. DSTs provide mailbox money, but also we can provide sleep at night money. So it's money that you can sleep at night, know that you're secure.
Yeah, I'm glad you say. Well, I used the word guarantee loosely, and I should slap myself because as soon as someone hears that, he said guarantee. But look, what are the odds that an Amazon building that have signed these leases for 10 to 15 years of rent? What are the odds that they belly up or full? I know anything is possible. It's not an insurance product. It is not FDIC. So thank you for pointing out the yes. I used the G word. Just it's 10 demerits for me.
We like to make sure that that everyone understands. That the use of the guaranteed word is done correctly, these are very, as far as the spectrum of investments go out there, these are pretty conservative investments, and we do cater to an older demographic that is looking for safety of principal, a predictable income, and hopefully some capital gains. Or some gains on their portfolio, some appreciation on their properties in the future, and that is our three principles that we adhere to. It's safety of your original investment equity, a predictable and steady stream of income, and hopefully some appreciation when a window of opportunity is open to sell.
Look, there's risk in everything. If you can get a 1% to 2% yield with no risk, you're risking not keeping up with inflation. So it's true. There's risk. Every investment out there has different forms of risk. Obviously, the biggest thing that people are afraid of is they invest their money in something and it just goes belly up and they lose everything. And that is something that people... They can recall certain investments that happened. Whether it was the 80s. I mean, there were insurance products that blew up on people in the 80s because inflation was out of control, and they factored in unrealistic returns when they did the hypotheticals, and people had to buy into to keep their insurance policies, or they went belly up and they lost it. So, same thing with. Look, I know that legitimate equities don't go to zero. It's usually the penny stocks and things like that. But my whole point is, yes, there's risk in everything. But first and foremost, this is solving a taxation issue, which, correct. Again, I really feel that people should address this. They should know that taxes are probably going to go higher. If I was a betting man, I would probably say that taxes go higher from here, from the fact that we've been printing so much money. Inflation is a reality. They have yet to increase short-term interest rates, and everyone's watching what Chairman Powell does. This is just another tool of the many things that you can do to defer your taxation and take advantage of gains in your investments. So, Rick, I really appreciate it. I love being a partner with you in Inland. Any parting shots before we end the podcast here?
No, a happy New Year to everyone. Hope you take your investment seriously. This is going to be an interesting year. Obviously, with all the unknowns that we have, we feel very, very good in the commercial real estate space. We believe we're in a super cycle for real estate assets, and we feel that we have very positive viewpoint of commercial real estate valuations and net income growth for all our products and all of real estate in general.
So
this
as
year.
you'd be considered a bull, not a bear,
Yes.
on this market, specifically commercial real estate going forward.
I would consider myself personally a bull
Okay.
in the commercial real estate market, correct.
Well, there you have it, folks. Rick Martins with Inland Capital. This is Denny Artache. Thanks for listening. We're going to post this on the YouTube channel, but you can, of course, listen to the podcast. It's on Amazon. I have it on Pandora, iHeart, and Spotify. Thanks for tuning in. And as always, if you have any questions, the corporate number is 561-537-5897. That's 561-537-5897. Hey, Happy New Year. Make 2022 whatever you'd like it to do. And please stay tuned. All right, thanks.